Welcome back everyone, and in this video, we're going to go over 5 of the top value stocks on the market right now. And JP Morgan says that the cheap and unpopular stocks are the best place to invest. And at this current moment, value stocks present the greatest opportunity across all equities, fixed income, and currencies. And the rest of the market has shot up since the height of the pandemic, but these value plays are still down a relative 30%, providing a great buying opportunity. So in today's video, we're going to take a look at the companies that are currently trading with very low valuations, very cheap PEs, and still have a ton of upside to grow over the long term. And all 5 stocks in this video do return investors with a cash dividend each and every quarter. So we have companies from various different sectors of the market that all have very low valuations and may be a great addition to your dividend stock portfolio. And before we jump into the first pick, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button and subscribe to the channel for daily videos. And the first value stock that we're going to go over today is Goldman Sachs. Ticker GS, currently trading for around $310, and over the past year, the company is up just over 31%. And even after this run up, they still trade at a crazy low valuation and a forward PE of only 10.7. And at this current point in time, their dividend yield is at 1.6% with a market cap of $111 billion. And if we take a look at a Morningstar report, the company's estimated fair value is at over $328, representing a 7% discount at this current point in time. And going forward, analysts are expecting some massive growth from Goldman Sachs. And the company has also announced that they're planning to expand their product line and offer wealth management to the masses over the next few years. And if we take a look at some financial stats, this company remains extremely profitable. Their total net income margin is above 22%, and over the latest quarter, revenue was up 19% year over year, and earnings grew 135% year over year as well. And taking a look at their income statement, over the long term, total revenue continues to grow each and every year. And in the trailing 12 months, they brought in more than $41 billion of total top line revenue. And with that high profit margin, they continue to load up on the net income, bringing in more than $9.4 billion over the trailing 12 months. And Goldman also offers their investors a cash dividend. The yield comes in at 1.6%, but it only makes up 17% of their total net income, which is extremely low, giving the company a lot of excess capital that they can reinvest back in the business to grow. They can do share buybacks, or they can continue to increase their dividend payment each and every year. And their 5-year dividend growth rate is at just under 14%. So overall, Goldman is one of the leading financial companies on the market right now, and they're trading at a very low valuation with only a forward PE of 10.7. And Morningstar has this company as being undervalued at this current price point. So overall, this means Goldman may be one of the top value stocks to add to your portfolio at this current point in time. And if we move on to the second company in today's video, we're going to take a look at CVS. The company currently trades just over $71 per share, and over the past year, the shares have been almost flat, down only 1%. And right now, the company's current market cap is at $92 billion, and they offer a ton of value at this current level. Their forward PE is only 9.3, which is very, very low. And at this current valuation, you can buy into this company with a 2.84% current dividend yield. And Morningstar believes that CVS is extremely undervalued at this current point in time. They are rated as a 5-star, which represents a significantly undervalued company. And the estimated fair value is at over $87 per share, and with the company currently trading at around 72, that represents about a 17% discount at this current level. And with the stock market trading at crazy high valuations, it's getting harder and harder to find undervalued companies in this high price market. So getting into a name like CVS that is estimated to be 17% undervalued, trading at a very low PE, is very attractive. And over the latest quarter, the company posted some strong numbers, beating on both the top and bottom line, and over the past 90 days, they generated just under $7 billion of total revenue. And if we take a look at their income statement year over year, total revenue continues to climb even higher. And from 2018 to now, we see a massive spike to over $265 billion in annual revenue over the trailing 12 months. And with the share price at around $71, the current dividend yield is at 2.84%, and that only makes up 27% of their total net income. So once again, a very low payout ratio to ensure that dividend will continue to be maintained over the long term, and the company has a lot of excess capital to reinvest back in the business. So right now, CVS may be one of the top 2 or 3 value companies on the market. They're trading at a very attractive level and at a discount according to Morningstar. So definitely take a look at this retail giant in the pharmacy space if you want a new addition to your portfolio that offers a dividend, an undervalued discount, and the potential for shares to climb even higher going forward. And now if we continue on to the third company in this video, we're going to take a look at Merck, ticker MRK, currently trading for around $75 per share, and over the trailing 12 months, the company's share price has dropped by over 10%. They have a current market cap of $187 billion and a forward PE of 11.5. And the company's current dividend yield is at 3.5%. And like always, if we take a look at their Morningstar report, the company's estimated fair value is at over $81, representing an almost 10% discount at this current share price. And right now, major investment firms are very bullish on this company. If we take a look, they are considered a buy. We have an overweight rating, and overall, there are some massive price targets. Many investment firms have issued price targets at around $100, $96, and JP Morgan has recently raised their price target from $98 all the way up to $105 per share with an overweight rating. So overall, a ton of major firms see a lot of upside in this company going forward. And with the current share price of only 75, that would represent a ton of upward momentum, plus that nice 3.5% dividend that you can buy into right now. And if we take a look, this is a big pharma company that is slowly continuing to grow year over year. The revenue continues to expand, and in the trailing 12 months, they generated just under $48 billion of total revenue. And to buy into this company that is expected to grow their share price, and you can collect a 3.5% dividend. And the net income payout ratio, once again, is extremely sustainable, making up only 40% of their total income, and they grow their dividend, averaging 6.7% each and every year. So you're locking in a nice middle to high yield at that 3.5% range, and that income is going to grow each and every year as well. So Merck is definitely another company to take a look at right now if you're trying to find some value in the high price market. And now if we continue on right into stock number 4, the next company is Verizon, ticker VZ, currently trading for $57 per share. And over the last 12 months, the company is actually in the red by 7.4%. This is one of the largest communication companies on the planet with a current market cap of $224 billion and a crazy low valuation with a forward PE of only 10.7. And this is also one of the highest yielding companies on the market with a 4.6% current dividend yield that is actually sustainable over the long term. And if we take a look at their Morningstar report, the estimated fair value is at around $59 per share, and with the company currently trading at 57, slightly below the estimated fair value according to Morningstar. And Warren Buffett just announced that he purchased an $8.6 billion stake into Verizon over the latest quarter. And that's incredible. This now makes Verizon the 6th largest holding in Berkshire Hathaway's $270 billion portfolio. And that's incredible. For the Oracle of Omaha to start a purchase with $8.6 billion, he must see a ton of room for this company to continue to expand and grow over the long term. And for even a company like Berkshire, $8.6 billion is a sizable investment. And that just shows he believes in the revenue and cash flow growth of this business down the road. And if we actually take a look, although revenues did take a slight decline over 2020 caused by the pandemic and the lack of travel, Verizon was still able to grow their cash flow by a significant amount. If we take a look right here, we have over $21 billion of total free cash flow in the year-end 2020, up from $16.9 billion in year-end 2019. So in the full calendar year of 2020, through a global pandemic, when many companies were strapped for cash and were actually losing cash flow, Verizon was able to bump up that number by a significant amount, which is great to see and shows how resilient this brand is. And these strong cash flow numbers only bring investors confidence that the dividend is very safe and will continue to grow over the long term. And if we take a look, their current dividend yield is extremely high at 4.64%. The payout ratio is at only 50% of their net income, and they continue to slowly grow it, averaging just over 2% annual growth each and every year. So not a ton of dividend growth, but your income is going to match inflation as time goes on. And when the greatest value investor of all time starts a massive position in Verizon, it really sends a message across all the market that this company may be at a very attractive level, there may be a ton of upside, and overall, Warren Buffett invests for the long term. He doesn't play short-term positions. So if he's buying into Verizon with such a significant position, he sees the long-term potential for this company to return both capital appreciation and cash flow from a dividend over the next few decades in the future. So definitely take a look at this leader in the communication sector for a very high dividend and a ton of value at this current level. And now we're going to transition into the fifth and final company in this video, and that is Bank of America. Ticker BAC, currently trading for around $34 per share, and over the past year, the company's still in the red by 1.6%. And we all know the financial sector got absolutely destroyed when the pandemic started. But from that low point, we've seen nothing but consistent growth, almost back to pre-pandemic levels. Their current market cap is at just below $300 billion, a current dividend yield at 2.1%, and they're trading with a forward PE of 14.2. And overall, I am a believer in the financial sector, and I think Bank of America is one of the few big name companies that will be able to transition to a more digital-based economy and actually succeed in our new e-commerce based marketplace. And if we take a look, their estimated fair value is at close to $38, representing almost a 9% discount at this current point in time. And Bank of America has been improving operations from the low points that we saw back in early 2020. And over their latest quarterly report, they beat analyst expectation on earnings and actually increased their forecast going forward. And some strong sign is that over the next 90 days, they plan to buy back $2.9 billion of their company shares, which returns a ton of capital to investors. And that's only in one single quarter. And that is the max that they are actually allowed to do because of the Fed restrictions. And going forward, I believe each and every quarter throughout 2021, they're only going to continue to buy back a ton of shares, increasing investor value each and every quarter along the way. And if we take a look, their current dividend is at 2.1%, a very low payout ratio of only 30%, and that dividend growth rate is absolutely incredible. They did cut it back in the financial crisis around 2008 to 2010, and then since that point, they were rapidly increasing it quarter over quarter. But of course, in 2020, the financial companies were not allowed to actually raise their dividend, and that restriction is still in place. But they are allowed to do share buybacks, so like we saw, Bank of America is still going to return a ton of capital to their investors over 2021 moving forward. So definitely do some research into Bank of America if you want some exposure and some value from the financial sector. I think early on in 2020, the banks fell too hard and too fast. The loan losses didn't come in like expected, and I think the companies are going to post record high revenue, massive earnings, and overall, I think these brands are going to grow past the pre-pandemic levels and still offer a ton of upside. So that was the fifth value company in this video, and overall, we took a look at different names from different sectors, such as Goldman Sachs. We also took a look at CVS. We talked about Merck, a big pharma name. We also discussed Verizon, a company that Warren Buffett has been buying as of late, and of course, Bank of America. So 5 very different companies from different sectors of the market that all right now provide investors with a ton of value and are trading below their estimated fair value according to Morningstar. So thank you for watching, everyone. I am the Gen Z Investor. Please hit that like button, subscribe to the channel for those daily videos, and I will see you in tomorrow's episode.